Okay, so good evening, everyone, and welcome to the annual conference of the Master 203, co-organized this year with Juliette Carrère. My name is Amélie Louzier. I am the head of the conference team, and we are really delighted that so many of you are attending the conference tonight. As such, I would like to personally thank you all for being here, and I also want to thank the very motivating and challenging conference team with which we organized this event. David, Victoire, Baptiste, and Jimena. It was a real pleasure to organize a conference with you during those 6 months and to constantly exchange on ideas. Tonight, we are honored to hold this conference on sustainable finance and to invite you to debate about whether finance can be a solution or not to fight climate change and to protect nature. I am really looking forward to hearing what our panelists' answers will be. To examine this complex issue, we are pleased to host 5 internationally recognized speakers, and the student body and I would like to personally thank the speakers for their presence tonight, their time and their dedication. It is Bertrand Badré, Andrea Blackman, Lucie Pinson, George Kerl, and Henry Winnett-Sillig. I would also want to thank Juliette Carrère, a former student of the Master 203 and founder of GKR, a sustainability and finance impact advisory firm. In fact, she will be moderating the debate tonight. If you have any question during the conference, we invite you to ask a question in the dedicated Q&A box by stating your name, your role, and your question. Then, some of them will be submitted to the panelists and answered at each section, at the end of each section, basically. So thank you again, and I am now going to hand over the word to Jimena, President of Student Society Strategy 203. I wish you a great evening.
So thank you, Amélie. Welcome again, and thank you all for being here today. The annual conference is one of the flagship projects of Strategy 203, which is a student-run association of the Master. Every year, we organize different events, and the annual conference is always an opportunity for us to deepen and share with you our interest in a current financial topic while increasing the visibility of the Master. This year, we're very excited to hold our conference under this new online format, as we are able to host more than 800 participants from all over the world. I must admit that even though we are all now Teams and Zoom experts after a year of online courses, this has really been a challenge for us. That is why I wanted to thank the Université Paris Dauphine, also the House of Finance, and especially IDA-MD for the technical support. I would also like to thank our Master's Director, Mrs. Gaëlle Le Foll, for her encouragement and guidance during the organization of the conference. To Juliette Carrère and the students of the Master for the implication and hard work over the past 6 months. And, of course, a special thanks to a wonderful panelists that are connected from New York, London, and Paris. It is a great honor to have you all with us today. I will now let Juliette introduce the speakers and start the conference. Thank you all again, and we hope you enjoy it.
Thank you, Amélie and Jimena, for this introduction. Good morning to those who are in the United States, and good evening, everybody, and welcome to this conference. We are very honored to have such a great panel tonight to discuss this exciting topic. We don't need to argue that we are facing real and urgent environmental challenges. All the financial sector largely communicates about its awareness of these issues, and sustainable finance is growing at an unprecedented pace. $40.5 trillion are invested today according to environmental, social, and governance criteria, which represents around 40% of total assets under management. ESG is becoming mainstream. It is therefore important to understand what is behind the evolution of the sector. Indeed, this raises a few questions we would like to address during this conference regarding the ability of the financial sector to bring real solutions to these extremely complex challenges. Sustainable finance, what are we talking about? Is finance an adequate answer to long-term issues? Does sustainable finance create positive impacts, and are we able to measure them properly? Should we move toward more binding regulations? And at the end of the day, can we think about a new purpose for finance? The financial model is still focused on short-term profit maximization. Can we imagine at a large scale a shift in the model to support a more inclusive and sustainable economy? These are very difficult questions, so in order to answer them, we are going to turn to the experts. So the experts tonight are Bertrand Badré, who is the CEO of Blue Like an Orange Sustainable Capital, an impact investment fund investing in emerging market companies. He was formerly the CFO of the World Bank Group. Prior to joining the World Bank, Bertrand Badré served as CFO at Société Générale and Crédit Agricole. He started his career working for the French Ministry of Finance before serving the cabinet of President Jacques Chirac. Andrea Blackman, who is the global head of Moody's ESG Solution Group. This sustainable agency enables companies, financial institutions, and governments to identify, understand, and quantify the impact of ESG-related risks and opportunities. She formerly managed Moody's Credit View, a leading research, data, and analytics platform that serves the credit market professional globally. Before joining Moody's, Andrea held roles with Citibank, Royal Bank of Canada, and Reuters. Lucie Pinson, who is the founder and executive director of Reclaim Finance, an NGO whose vision is to create a financial system that supports the transition to sustainable societies that preserve ecosystem and satisfy people's basic needs. In 2013, Lucie Pinson started working for the NGO Friends of the Earth as finance campaigner, with a focus on the issue of fossil fuels, in particular in coal. In 2020, she received the Goldman Environmental Prize for the European region to recognize her work on coal. Ellery Wynette-Sealing, who is the head of ESG for Markets and Securities Services at Citi. Prior to joining Citi, Ellery held roles at BNP Paribas, Lehman Brothers, and Nations Bank in the field of commodities, natural resources, and project finance. She also spent 10 years working in conservation and community development in Southern Africa and consulting for venture capital firms investing in renewable energy. And George Kerr, who is the chairman of the board of Arabesque, a global tech group offering sustainable investments, advisory, and data services through ESG and AI capabilities. George Kerr is the founding director of the United Nations Global Compact, the world's largest corporate sustainability initiative. In his career of more than 25 years at the United Nations, he oversaw many other of the Global Compact's sister initiatives. He started his career as financial analyst in Africa and Asia. So before letting the floor to our panelists, I would like to explain how the conference will work. We have 1 hour and a half debate around 4 main parts. So first, a brief history of sustainable finance and an overview of the current situation. Then a focus on the opportunities for the financial sector to shift toward more sustainability. Then in the third part, the challenges and threats that could jeopardize the shift. And finally, we will question the purpose of finance in a long-term perspective. So I let the floor to Georges Kerr to give us a brief history of sustainable finance. Thank you.
Thank you very much, and hello everybody. It's a real pleasure to have me with you. I'm speaking here from New York. I hope one day we will be speaking face to face again very soon. Giving a brief history of sustainable finance is not easy. The history is obviously very old. Ethical finance has been around for decades, for hundreds of years, first movements, anti-slavery, and so forth. But it was always a marginal movement, a tiny portion of the world of finance. In 2004, former Secretary General Kofi Annan invited major asset owners to a working group called Who Cares Wins. And after 2 years, we produced a report which framed and coined the term ESG, where asset owners for the first time publicly pledged to integrate environmental, social, and governance issues into their analysis and decision-making. A year later, we launched the Principles for Responsible Investment at the New York Stock Exchange and a few other initiatives, including Sustainable Stock Exchange Initiative. The idea then and today with ESG is that some of these factors are not yet accounted for in the world of finance, although They are considered to be materially relevant, meaning they can have an impact on the bottom line. Initially, that thinking was embraced by a few asset owners, not too many, 40, 50, and they made some progress, marginal progress, but not really much happened. Then came the financial crisis. You will remember a struggle went on about regulation and how to control finance, and not much happened on the ESG front. A breakthrough, in my view, happened around 2013-14 when the first empirical studies came out, including one by Arabesque, meta-studies that established a correlation, a relationship between good ESG performance on the one hand and long-term valuation on the other. And this was a breakthrough because that showed the business case for ESG actually is not wishful thinking. It actually can be demonstrated with hard figures. And that made many players around the world interested in ESG, and that's where the real movement on ESG started. Paris 2015 was a high point in this regard. It was my last activity with the United Nations. I'm very proud to have brought finance and corporate players to Paris. The issue of climate risks has now clearly added enormous momentum. And it's fair to say that today, I believe, finance is in the midst of a revolution. All of a sudden, these non-financial issues, climate change, human rights, social disparity are understood to be important, but many financial actors still are struggling on how to wrap their head around it, how to come up with different types of valuations, and how to square the long term with the short term. And many questions are still open, but the momentum today is enormous. And I would even argue, while finance is a latecomer to the sustainability agenda, very late, the corporate world has started much earlier. Today, we see a convergence between the corporate sustainability movement and sustainable finance. I may just point out, I just co-edited and published a book on that theme, on the convergence between corporate sustainability and sustainable finance. This in itself will greatly accelerate, and obviously regulatory changes are happening and will happen ever more. And three long-term trends clearly indicate that sustainable finance is the new normal. ESG investing will become the new normal within a few years, I have no doubt. I hope I didn't extend my allocated time too much. Back to the...
Thank you, George, for these insights. I'd like to have now Bertrand's vision, and especially since the Paris Agreement, what happened and what is the current situation of the market, and what is your point of view?
Yeah, like Georg, I'm kind of more optimistic than I was in 2015. I was part of the World Bank squad on these issues. One of my frustration then, which has remained and still to a certain extent is still valid today, is that we moved a lot towards the SDG, we moved a lot towards climate, and we didn't pay enough attention to the way to get there. So we agreed on the objective and we expected that everybody will follow suit. I mean, you had everybody was committing, and that's also the purpose of the book I just released, which is, do we seriously want to change the world? So it's not about adding commitments to commitments, it's about being very serious about this. And that's for me the difference between the glass half full or the glass half empty. So I agree there is something. I remember in 2015 I led a conversation actually with Mark Carney and some others on the silent revolution in finance. Today, 6 years later, it's less silent, but it's not yet a revolution. And for me, this is really where this conference is important today. There are two things that we should focus on. First, how much can we do within the existing system? And the existing system leaves a lot of room for individual or collective commitments. People try to say, I want to do this, I want to do that. You have this coalition of financial players, these coalitions of corporate teams. I've worked a lot with Paul Polman on Tipping Point, putting together people in the fashion apparel business and say, what can we do to be more sustainable together? And I agree, it's okay. That's what the type of things we can do today. And so let's push maximum the system today. But don't lose sight of the fact that the system today is not the system we need to go further. It will reach its limits. So I pay really a vibrant homage and tribute to ESG and PRI, but for me, they are just the first building blocks. It's very largely still based on declaration. It's not always checked by third parties. And for me, the ultimate goal is to reach a real impact. What have we transformed with all these good efforts and good intentions? And that's where we need to be very ambitious. That's where we need to keep pushing. You can't leave people be happy with just, oh, I've committed all these great things, and then you lose sight of what did they commit. I mean, you have so many climate coalitions that have been announced since 2015. I just don't follow. And even this morning, I was pitching my fund to an LP, actually, in one of the most progressive environments you can imagine in Scandinavia. And the guy say, well, I think sustainability is very important. Personally, I think it's important, but for me, performance matters first. And so we discuss impact and sustainability separately. So that's the reality. I mean, it's even more true in the US, actually. So I think we are on the verge of making something different, but we should not fool ourselves. We have the ingredients on the table, we have the building blocks, but the challenge is really to build based on these building blocks. So again, what we've learned over the past 10 years is extremely useful. What we've done is extremely useful. Now it's time to bring this to another stage and not just play within the system, but work on the system itself, including all the pipes and mechanics like the accounting standards, the remuneration policy, the fiduciary duties, I mean, the governance principles, etc. If we don't do that, the system will remain very fragile and prone to washing.
Thank you. Thank you, Bertrand. All very interesting ideas we're probably going to discuss further. I'd like to hear what Lucy can tell us more specifically on fossil fuel funding, which is at the heart of our work at Reclaim Finance.
Yeah, thank you. I'm very happy to be here, and I could not agree more with Bertrand than today. It's a lot about statement and not really much about how we get to the objectives that we give to ourselves. Since COP21, sorry, banks have growingly speak about fighting climate change, and they have pledged to align the financial services to the objective of the Paris Agreement. And the last station is definitely to commit to achieve carbon neutrality by 2050. But actually, when it comes to financing fossil fuels, not much has changed since 2015. And I will present some numbers that will provide a sobering reality check on financial institutions' climate commitments. So according to the Banking on Climate Change report published last year, a report that we publish every year and that we are going to release in 2 weeks' time from now on, 35 global banks have provided $2.7 trillion of financing to fossil fuels companies since the Paris Agreement was adopted, with an annual amount increasing each year since 2016. We should reduce financing to fossil fuel. It has been increasing. In last December, we published another report exclusively focusing on 12 of the most devastating fossil fuels projects that are currently being planned or under development. These projects are being pushed forward against local resistance and despite numerous calls by scientists and numerous political leaders to phase out fossil fuels. Among them, you will find some oil and gas drilling in the US Permian Basin, in Argentina, Vaca Muerta region. It would be shale gas in that case. You will find coal and gas consumption in Bangladesh. You will find drilling in the Barents Sea in Norway. And you will even find, not far from here, offshore drilling in the UK. And these expansion projects alone will use up 3/4 of the total remaining carbon budget. If we have to have 66% chance only of limiting global warming to 1.5. And what we found is that these financial institutions have provided $1.6 trillion in loans and underwriting since January 2016. And at August 2020, invested $1.1 trillion in bonds and shares in the companies behind these 12 fossil fuels expansion projects. And we could think that maybe French banks that are pledged to really protect the climate since COP21 are doing better. And it will be honest expectation considering Paris has the ambition of becoming the capital of green finance. But actually, with $116 billion of financing to these companies, BNP, Crédit Agricole, and Société Générale still rank in the top 20 biggest oil and gas financiers. The issue is actually not necessarily that banks are financing fossil fuels and fossil fuel companies. The issue is that banks are making financing to fossil fuel companies with no condition to end in fossil fuel expansion. And that's clearly against what climate science is telling us. According to a report by the UN published in December, we need to reduce the production of fossil fuel by 6% every year till 2030. And this means an 11% reduction of the production of coal, a 4% reduction of the oil production, and a 3% reduction of the gas production. So these projects are not only against climate science, but they could be considered illegal if we were serious about the commitments that we have made in Paris in 2015. And we are not yet there on coal. Today, we have around like 40 banks that have pledged to stop financing direct support to new coal projects, but we have only a tiny number of these banks that have actually stopped financing the companies behind these projects. And as you must know, project financing is only a minimal share of the overall financing to the coal sector. So one last number, and I will stop there. With our partners, we have published another report in a few weeks ago, which is actually groundbreaking research that no one has done before. We have looked at the financiers and investors behind the entire global coal industry, so behind the 935 companies on the global coal exit list. And what we found indeed is like hundreds of billions of financing through lending and underwriting to the companies active in the coal value chain. But we also found that the number of financing to the coal sector has grown since the Paris Agreement was adopted. So I think this number clearly tell you a lot about how serious are financial institutions in supporting the energy transition. You are on mute.
Sorry, thank you all for this introduction and all these very precise figures, Lucy. We're going to now explore in detail the reason why the financial sector should shift toward more sustainability, and what are the real opportunities, and how environmental challenges impact the financial sector and reshape its offering. And I let the floor first to Ellery from Citi, who's online with us. Ellery?
Super. Thank you so much, Juliet. Can you hear me?
Yeah.
Brilliant. Good. And thank you so much for joining me. I'm sorry that I couldn't join with video. It's great to be a member of this panel, this esteemed panel, and to discuss where ESG is now. But I think it's really equally important to think about where we're going in terms of sustainable finance, and what we can do to finance climate protection, to work against climate change, and obviously to protect nature. So in my role as head of ESG for markets and security services at Citi, I work with corporates, investors, sovereigns, municipalities, and others to really help them achieve their own sustainability goals. So I'm going to speak to my experience with speaking with them every day about what they're trying to achieve and their challenges. And I'm going to start with actually thinking about how we frame ESG, and that will give hopefully a bit of a context to the rest of my comments. So in terms of the nomenclature, I'm going to use the term ESG to include ESG, which is really at its heart about risk, but it also, in the way I'm going to use it, is about socially responsible investing, outcomes-based investing, or dual return products, impact investing, recognizing that they aren't the same thing. I think of them as a spectrum, and clients are across that spectrum. And I think it's really important that we need to clarify those definitions and what ESG means, because it means different things to different people, because it represents our values, which are personal and they're cultural, and they change over time. And they actually change across an organization or across an asset manager or across an operation, across operations in a corporate. But hopefully they have an overarching principle that unite them. The way they're expressed can be different. I also think it's really important to recognize that different clients or different organizations are trying to achieve different things with their ESG strategies. Some are very much focused on managing risk. So they could be focused on the physical risk associated with climate change. They could be associated with the headline risk of investing in tobacco or gambling, or a firm that has, I don't know, controversial weapons. They could be worried about performance risk. They could be worried about price risk. Others that we talk to are really worried about aligning with values, because we know that consumers are trying to align their spend with their values. We know that investors are doing the same thing. And some, like many of our hedge fund clients, are really trying to participate in sustainability themes. So ESG is important because it is driving change across the financial system. And there are opportunities across this whole spectrum as well. When we think about ESG, we think that it's a momentous shift in our markets. Realistically, assets will reprice as we take into consideration these pre-financial ESG factors like greenhouse gas emissions, like board diversity, like team diversity, like governance. Also, capital will be deployed using a different lens. Instead of just worrying about shareholder returns, they're going to worry about, and increasingly investors and corporates are worried about stakeholder returns. But the reality is, it's also just another lens that our investors or corporates are using. I think Bertrand mentioned that when he was speaking with a client, the client first said, I care about my returns. The great thing about that is, looking on a risk-adjusted basis, 2020 shows that we get good returns on a risk-adjusted basis with ESG strategies. We can talk about whether or not they hold if we actually shift to a value or a growth sort of model, but generally you're not giving up return by aligning with values and by integrating these ESG factors. So where is the market right now? We think in terms of the fact that the market has really just entered what we call ESG 2.0. When we think about ESG 1.0, probably has been the last sort of 5-7 years, where you have a lot of asset managers that are integrating these pre-financial factors. I think I don't remember, I apologize, whether it was Georges or Bertrand who mentioned non-financial factors. We think of them as being pre-financial. Now, the reality is the ability to perform under a contract, because if you are impacted by drought or flooding, under weather events that are induced by climate, are actually very material. So we call them pre-financial factors, and they become really important when you start integrating them into to create a risk-adjusted return. And that's what ESG 1.0 to me is really about. You have a lot of the asset managers that are starting to integrate these pre-financial factors to adjust their risk-return profile. Most of the strategies that were used were largely in equities, largely using exclusionary screens, mostly starting with index, prevailing benchmark indices like the MSCI ACWI or I don't know, pick any of them. And what they did was they applied exclusionary screens. They said, well, I don't want anything that violates the UN Global Compact. I don't want anything that has tobacco, and so on. So they were rather simplistic strategies. And that's probably 70–80% of the AUM, the assets under management right now. But what's happening, and I think what we think has happened, is that the pandemic and Black Lives Matter has really accelerated adoption. combined with that good performance that I mentioned earlier. And it means that it's really accelerated the shift from making this ESG and SRI, socially responsible investing, being this sort of niche thing that sits in equities. It's really expanding across the capital structure of a corporate. So whether you look at the sort of the short term, the medium term, the long term liabilities, as well as assets, people are changing their business models, they're changing their investment strategies, and it's across fixed income. So that whole sort of that shift to ESG 2.0 is happening. I think one of the questions that was proposed was really about how fast does ESG integrate into the market, and I'm going to say in some ways it's quick, but in other ways not so quick. Adoption has been slow. But there are tipping points. When we talk about markets, we frequently talk about tipping points. I spend a lot of my time focused on where does climate risk integration, what are the transmission mechanisms, what are the transmission channels, and what are the tipping points for pricing climate into market. But so we get these tipping points that happen in markets. So adoption has been pretty slow up until there's a critical mass in either consumer interest, investor interest, or what all of the other asset managers are doing. But it's difficult because firms have to decide what they mean by ESG, what they want to achieve with ESG. ESG integration is really difficult because integrating those non-financial factors, repricing, data quality isn't great. But realistically, the simple strategies in equities that I mentioned, where you just apply those exclusionary screens, you start with a benchmark index, that's really easy. And in fact, we saw about 220 indices in Europe alone relabel themselves in 2020. So that asset growth that we've seen is really important because it shows a trend. But if you tear into it a little bit, you see that some of it is just relabeling. It doesn't mean that they aren't ESG compliant strategies, but it doesn't mean that it's new assets under management that has been raised. But that being said, even the new strategies that are being developed are a little bit more difficult. I'm not seeing from our clients, which are mostly the major institutional clients, I'm not seeing a lot of conviction around thematic strategies, although we do see a lot of conviction in the retail market, particularly around climate. I'm going to pause there.
Thank you, Hilary. So we see that, as you said, there is a transition from ESG 1.0 with from negative screening to positive value creation. Thank you for this overview of the market from your bank's point of view. I'd like to hear now Andrea regarding those questions of sustainability offer and from the agency point of view.
Sure, thank you, and it's a pleasure to be here. Thank you for including me. You know, I heard Georg say that corporates have embraced sustainability for some time, and I'm going to challenge that a little bit because I think there have been various stages, and when we talk to corporates, they can sit on a spectrum. One can be they're concerned about their marketing profile. And you see that through their corporate social responsibility and their sustainability report, and they're very focused on the words they use to describe themselves. The next stage is, the corporates that are concerned, and I think it was also mentioned, they're worried about reputational risk. Then there are those that focus on operational risk. And then in sort of the hierarchy of needs, there's those that have embraced it as core to their strategic resilience and their long-term positioning as a company for the future. And there are very, very few companies that fall into that. And there's a certain amount of reluctance for corporates to necessarily open the kimono and really go public on what their core ESG and sustainability performance is for a whole bunch of practical reasons. One is the definitions around what constitutes performance and what constitutes risk in the sustainability arena isn't well understood or agreed upon. I think the other challenge is that the information that you would measure on a regular basis in order to manage your performance is spread all over companies. Okay, it can be in the HR department. It can be in the operations department. It can be in the corporate social responsibility department. It can be in the finance department. But there are very few companies who have the systems or the focus to have brought that all together under a management system that uses guiding principles around sustainability to manage that actively. So one of the things that they have to do is they have to think about, how am I going to get there? At Moody's, we have a series of products that start to help benchmark companies, but there isn't a big history. Okay, so you can start to score them based off of what? Based off of disclosure, based off of controversies, okay? Based off of methodologies that start to evaluate multi-stakeholder impact based on principles of dual materiality rather than financial materiality. Okay, and there are a lot of companies that are doing that. Some of them apply a technology-focused AI approach, which is trying to apply technology enablement to big data in order to bring scores together that are big enough in terms of the universe in order to create benchmarks and be useful for indices. The other thing you can do is you can deeply engage in a fundamental way with something like a sustainability rating. And even that term isn't well understood. But what I'm talking about is companies who actively engage, want an in-depth analysis in order to understand where they are, which is frankly probably at the very beginning of what's going to be a multi-year journey. Okay, and then when they decide that they want to issue into the green markets and it doesn't address the problem that Lucy highlighted. Okay, these are people who are trying to go out under a green flag and say, we want to finance green initiatives, green projects, transition, okay, social programs, but it doesn't actually apply a label to other activities that don't fall under that are continuing to get financed today, but at least it's a start. So you have what are called second party opinions that will evaluate the green credentials or the use of proceeds or the alignment to a company's stated framework for the funding that they're raising. And so what that starts to do is bring accountability around what is the corporate doing with the financing they're getting in order to transition towards a more sustainable future. And it's really just a beginning. The involvement, I think, of the asset managers and the banks we're going to talk about a little bit later, but from the corporate perspective, the sustainable finance products are there to start to bring quality, integrity, and transparency to what people are doing and evaluate it under a transparent framework that makes it easier to understand and to determine whether or not it's going to be positive impact under whatever framework you're considering it under or whatever standards you're measuring it against, whether it's SDG or whether it's something else, in order to give investors options around what they deploy their capital against. And I will pause there.
Thank you. Maybe George, you can add something, and especially regarding the use of AI in the disclosure and measurement of that data.
Yeah, I have 2 comments. I agree with Elry's observation that the momentum is extremely strong currently in the world of finance in embracing ESG 2.0, and it's largely technology driven because AI and big data analysis now makes it much easier to apply additional factor analysis for assessing risks and opportunities in line with the sustainability priorities. And that is, I believe, the real reason, one of the real reasons behind this mega trend that is playing out now. I also have an observation on Andrea's last comment. I do not quite agree. I think we are right now this year in the midst, also in the corporate world, of a major waking up. And I give you two figures. In the run-up to Paris, we put together the science-based targets, and we hope to mobilize 40 CEOs for Paris, which we did, which committed to decarbonization in line with science-based targets. And today, Science-Based Targets has over 1,000 corporations as followers. TCFD has gone through a similar explosive growth, and it's happening right now as we speak. Decarbonization, in my view, is becoming a central strategic element in many sectors already. And I happen to work with a few CEOs from different sectors, mostly in Europe. And I can assure you that the notion of decarbonization or negative carbon as the currency of the future is gaining enormous board momentum and attention. And let's stick to the climate agenda in a narrower sense. It's largely about the transformation of the energy sector, as Lucy pointed out. And here we know what has to be done. We know what solutions are available. And when we talk about energy transformation, it's a huge shift that is right now in moving. Look at e-mobility. E-mobility was laughed at 4 years ago. Today, the major consensus now is, well, e-mobility is the way to go, but with it has to come recycling of batteries. Otherwise, we create a new problem. So this is a major transformation. I would argue that finance has a critical role in all this. ESG is shifting away from the old mindsets towards the new mindsets. But transformation of markets is a holistic, complex undertaking where everybody has to be involved. And I agree also with Bertrand's comments that the system currently we are working in will not deliver the scale and the impact in time to deliver. And that's where voluntary initiatives, finance and corporate activities, although they now come together in understanding risks, it is not sufficient. We also need to change on the regulatory side. And clearly, until and unless we have a really high price on carbon, the market incentives just won't be there because the market signals do not reflect what most, at least the scientists and many others, consider to be the true value. We have not put a value on natural assets at all in our old mindset of the world of finance. This is why this revolution of ESG, I believe, is a bridge. In my view, it's a transient phenomenon. It basically says, look, we have real challenges and real risks and also opportunities ahead of us, which we are not yet pricing into our day-to-day activities. Therefore, we need a bridge into the future. So I see it as a bridge into the future, but the momentum currently is just enormous. I must say, after 20 years of being in that space, or since '92 actually, since the Rio Earth Conference, I'm all of a sudden amazed. The Biden administration's new appointees are all people like me and you. They come from the same mindset. So wait and see how the US will gear up. It will happen. Europe is leading on some of the taxonomy issues and improving the disclosure phenomena. If the US and Europe come together and if they manage to win over China again, we can have not only a replay of Paris 2015, we can have actually a real systems change in the making. And finance has a fundamentally important role.
Thank you, George. I have a question coming in for Elri. How do we make sure that we are not pushing things clients do not need, at least yet? For example, looking at CDS ESG indices and their really difficult start, it seems that clients did not want or need this kind of ESG solutions.
Hi, thanks so much for the question. You know, I'm going to actually give you two answers. I'll answer the CDS question first, and I'll answer the question about pushing products separately. The CDS is actually a really complicated issue, and actually one of the problems that we have within markets is actually the regulatory environment, and some of it is actually the follow-on on what happened during the global financial crisis, and they want to make sure that the major banks, the globally systemically important banks, are very sound, and that is a very good thing to do. I don't want to lose my job. I don't want to cause chaos in the market. But we have a lot of constraints, and actually that's one of the big, when I mentioned a little bit about building products and momentum in the market. And I would agree with Georges that we have incredible momentum, and I'm super excited. And I come from a generation, I actually studied pricing in a PhD, studying ecosystem services, pricing ecosystem services. And the reality is 30 years ago, nobody cared about doing that. And now we are starting to integrate that, and the momentum, I think, is irreversible. But we have a problem sitting in a market seat. We are not allowed to take illiquid risk on our books. And one of the things we can talk about later is how do we get more money into this market? One of the first issues is that AUM, there's a lot of AUM in the market, but it has been raised. When you tick the box of saying, I want an S&P tracker or I want an iStocks ESG fund, and the reality is it needs to be allocated against that strategy. So just because there's a lot of AUM doesn't mean that it can be reallocated. So that's one important thing that we have to deal with. We need to raise new AUM. We need to migrate portfolios that track broadly against the benchmarks that they were created. The second thing is we need to create, there's a tipping point, going back to my tipping point, CDSs, that CDS that came into the market, there's an iStock CDS that was launched almost a year ago. The fact is everybody can trade it, but nobody wants to because nobody can take the risk. Because if we take that risk on our books as Citi, we have 100% capital requirement against it because it's considered illiquid. So one of the things that Citi has committed to do is to create deep, liquid, sustainable markets. And we see that happening in the carbon market. We see that happening in the CDS market. We need institutions, we need quite frankly, the support from our supervisors and our regulators to allow us to help the creation of this market. So when you look at whether that CDS was successful, you can't look just at was there investor appetite, there also needs to be market making appetite. And right now, there is no market making appetite because we can't price it to be able to take that risk. So I'm going to pause there. Oh, I guess I didn't answer the question about how do we not push products that people don't want. I think all of us, and Citi has been part of the task force for scaling voluntary carbon markets, and we are, so I think one of the things that we try to do is to make sure that we establish minimum standards for what a market looks like. Certainly at Citi, whether it is KPI, sustainable key performance indicator linked products, whether it's a loan or a risk management, a revolver, a bond, whether it's carbon offsets, the voluntary carbon market, we create a framework that needs to be approved by our sustainability team, by our ESRM, our environmental social risk management team, by our senior management team to say, this is the minimum standard and this is how a product can be deployed. And ultimately though, so there are certain standards that we have, but ultimately it will be up to the client. As a markets person, we are not allowed to be advisors. So we can't say this meets your need. That's something that needs to be independently sourced. But the market ultimately pushing products that people don't want, the reality is the market tells us that. We have a gazillion funds of one, what we call funds of one that have been launched and haven't been successful. So we think that we have a great, not we, the market thinks they have a great strategy. In fact, one of the really interesting one is the climate vegan index. And you think that you're investing in something like Beyond Meat, but in fact, what you're investing in is Apple, Edge, Microsoft, and a lot of the tech firms. But there are a lot of funds that have been launched, and it's a big frustration. Decent looking strategies on paper, but they haven't built the AUM that they need to be successful.
I agree.
Thank you for this very complete answer. We now have to move on to the next part to analyze some challenges you already mentioned. We'd like to focus on two major topics. We are data and regulation. So first, I'd like to hear Andrea on the data challenge. What are the main issues regarding measurements? And what is Moody's approach and vision for the future?
Okay, thanks very much. I think maybe Georg might have misunderstood me. I'm in complete agreement that there's loads of momentum. I'm in agreement that we are at a pivotal moment that is going to transform this into permanent change. What I was trying to say was there's still a lot of work to do.
Okay, I agree.
And data is one of the hardest areas. Moody's engages all the time with regulators, standard bodies, and accounting standard setters in order to give them the insight and expertise to start setting disclosure standards that we can all harmonize to. Hopefully that'll happen internationally. I think with the arrival of the Biden administration, you can see the shift occurring in the US, and I think everyone's delighted. Europe has taken a lead on this, and the EU taxonomy and the green bond standards and all of those things are contributing. But at the end of the day, it comes down to what is the information being disclosed, what is the form that information takes, and what can you do with that information to understand the impact of the activities that are going on. And you can do it in three places. You can do it for the corporate, you can do it for the banks to look at their portfolios and their exposures and their asset allocation. And then the asset managers and the asset owners who are driving the demand for this in order to respond to customer and sponsor requirements are key users of this. And the banks and the asset managers, asset owners are points of aggregation, right? And they can apply scrutiny, and they can do it in a whole variety of ways. I think Ellery was talking about, you know, the importance of the cost of capital for a bank and how they're going to manage to those requirements, and that there needs to be liquidity. For the asset managers and the asset owners, they need to know that the information inputs they're getting can be relied upon and are of high quality and provide insight. And so one of the areas that we're very focused on is how do you bring quality and integrity to what some academics have labeled aggregate confusion around a lot of the measures and the metrics that are out there. And so we are going, you know, we are very diligently moving through a definition of taxonomy that will be standardized at Moody's across everything we provide. And we provide the reviewer services for the sustainable finance market. We provide the ESG data tools and metrics, and we provide risk management analytics for banks. And we do that across large corporates and small, medium enterprise. And what we're trying to do is make sure there's data quality and integrity, but that it also spans across the range of the different things that people need to understand in order to take a view about the risks and opportunities they're assuming with either their exposures or with the loans they're making or with the investments they're making. Okay, so I think there's a long way to go. And I think the reason we're at a pivotal moment is not just because consumer behaviors are changing, but because regulators are engaging, standards bodies are engaging, and all of the constituents that need to come together in order to make this a reality are starting to say, let's get this right so that it's not just an exercise in greenwashing or green wishing, and that we can really move forward with this in a meaningful way where, and I agree with you, Georg, we have to price things that historically haven't had a value, that have been absorbed as costs through externalities that don't necessarily get absorbed by the corporate. They manifest themselves elsewhere in society or in healthcare costs or in environmental damage. And you need to make sure that that gets returned to the place where it can be influenced and where it can be managed from source so that people are creating product and capability that actually works to a dual materiality objective and multi-stakeholder impacts rather than just what we've done, frankly, for 30 years, which is shareholder value and financial return. So I will pause.
Thank you, Andrea. Bertrand, could you say a word regarding regulation and what has been done already, and especially under Europe's leadership? And we could have a look on what would be the implications in terms of geopolitical balance. We can't hear you.
Sorry, even after 1 year of this, you forget to unmute. My big fault. No, I say it's a very important question because on the one hand, as we have discussed, there is a momentum on the side of the market participants. And by market participants, I mean not only the investors, but also the consumers, the staff in companies, the entrepreneurs, everybody around the table, the students. So there is a growing appetite for that. But again, it's a momentum, it's not established, it's not firm, and there is no guarantee it will last forever. If we have another COVID crisis and the central bank cannot print that much money, we'll see how much it will last. So let's be realistic. It's getting there, and we have to encourage that. And I think this is why we need another point, which is the norms and regulations. And here again, we should not fool ourselves. This is not a kind of neutral, boring technical exercise. This is not. And sometimes I've discussed that with a number of ministers. They say, well, how do you want me to go on TV at 8 p.m. to discuss with the people accounting standards? Nobody cares. Yeah, maybe, but this is very important. This is very important because it reflects a vision of our life. And bottom line, it's a real question. I think, as Georg said, on climate, we're getting there. I think after 20 years of GIEC work, etc., people kind of understand where we are. But climate is just one piece of the puzzle. What about nature and biodiversity? What about land use? What about water? And when we move to the S, it's even more difficult. And social issues are very difficult. Inequalities are very difficult, etc. So we are just at the very beginning. And so that's why regulation cannot just be left to technocrats who say, yes, let's agree on what is to be done. I think it's really about agreeing what is right and what is wrong, what is good and what is bad. And let's be honest, we don't have the same vision all over the world. So there is a geopolitical aspect to that. Just let me take an example. Ethnic diversity. I live in Washington. So in the US, I received a questionnaire from somebody wanting to evaluate us regarding the ethnic diversity of my company. And my answer say, I'm French, this is illegal in French. So this is a vision of the world. You see the clashes between the French and the US and diversity and relationship with religions, etc. The relationship to tax is also a big issue. The relationship to staff representation in board is a big issue. So who is going to decide what is good and what is not good in the next 10, 20 years? Will it be decided by Andrea, Moody's and S&P, etc.? Maybe. That's probably actually a natural outcome. Or will it be decided by the European Commission with the taxonomy and other regulations? Will it be decided by Bloomberg and BlackRock? I don't know. My point is that I wish we could find terms together and agree on a way forward. But this is going to be very, very challenging politically because at the end of the day, it's about the values and the way we see the world going forward. So I think there is a lot of work to be there. It's not a technical work, it's a difficult work. And again, as I say, discussing accounting standards. I mean, the accounting standards, very interestingly, it's a baby. It's like the national accounting. They're finished there, Juliette, don't worry. Everything was born out of the 1929 crisis. I mean, when Keynes wrote his general theories, there was no GDP. We created the GDP with all its imperfection. We're still measuring what we do today with that tool. And Joe Kennedy was the first head of the SEC, created by Roosevelt, asked for convergence of accounting standards. So this was born after the last very big crisis. Now we are facing a new crisis. Maybe it's time to revisit GDP and it's time to revisit accounting standards. Everything, the accounting standards are mark to market. Does it make sense? I really want to discuss that in depth. As I say, we should move from mark to market to mark to planet. That would be a much more attractive proposition. Thank you very much. And I'll pause there. You're on mute, Juliette.
Our moderation is silent.
You're on mute, Juliette.
I'm sorry, there was a technical bug. Maybe any reaction from George or Lucy on this regulation topic?
Maybe just a quick reaction. In my own mind, I think there are three mega trends which are driving us forward. Also in a messy world, not coherent, but the direction of the change is very clear. Number one is technology. Digitalization and AI is so transformative. It is changing all activities of our lives. It is changing how we invest, the investment processes. It is affecting all aspects of human activity, including governance. And giving a purpose to that direction is key, I would claim. So AI for a purpose is key. Technology for a purpose. In ESG, we find it already. Thanks to technology, we have now simple tools available that can measure the carbon footprint of companies. I hate to do advertisement, but our temperature score does exactly that, thanks to big data and AI. Secondly, planetary boundaries are for real. Scientists tell us we will increasingly be forced to react to changes we have caused through our industrial era mindset activities. And that will force public and private actors to adjust, to adapt. So we better get there before we react in panic. And that's what we should have learned from COVID. So I do believe we will be forced in this pathway forward, even in a messy world and not well coordinated. But the direction is clear. And the third one, the most complex of these driving forces, is social norms. Yes, they play out differently in different societies due to history, due to expectations. But even there, we can see that young people in general have a much greater affinity with this agenda. And the world is full of young people, and they all drive in this direction. So I'm a bit more optimistic that these big mega forces that are driving ESG investing and sustainability forward will increasingly set the tone in policy making at international and at national and at local levels. It's not something that is a short-term bubble. It's something that is fundamentally transforming societies and markets and finance in particular.
Thank you. Thank you, George. I see a question from Basil Revel. How can banks and financial institutions produce relevant ESG products since, according to MIT reports, ESG scores are correlated at 41 to 73% at best, when credit notations from the three major rating agencies are correlated at more than 99%? Maybe a question for Andrea.
If I could, well, in fact, Andrea, you go first, and I would love to pick this one up as well.
Go ahead, Henry.
Sorry, so actually there was an interesting study about EU bonds and where there was convergence on scores. And what they found is, so obviously ESG data has a million issues with it. Companies like Moody's and others are working to get us the data that we need. It is still very early days, but the reality is it's improving, and it's also underpinned by improving disclosure. And until we have disclosure, we're not going to necessarily have great data. That being said, we also have natural language processing. We have other forms of AI that are helping to enhance the data that is disclosed. But going back to the lack of convergence, I think that we have to think about ESG ratings differently than we have to think about credit ratings. They aren't the same thing. They don't measure the same things. And what we found is, or what the analysis found, I saw it a couple of months ago, they took the EU bond, like ECB bond portfolio, and they said, where is there convergence, where is there not? And if you look at a normal distribution, there was agreement on the two wings, basically, the outliers on the poorly performing and the well-performing. And certainly what we're seeing from servicing our asset management clients and others is that the difference that you get in the middle is obviously underpinned about the methodology and so on, but the reality is that is also where there is the opportunity for alpha. If you have the ability to engage, if you have different ways of looking at that risk, of pricing that risk, of evaluating the opportunity. So in fact, that is a point of differentiation, particularly for our active managers. And it goes back to the idea of people want to achieve different things. The other thing I think is the problem is we are using ESG ratings. We're getting better. We're using materiality, we're using momentum, we're actually looking at granularity, but we're using them for portfolio construction sometimes. And certainly even under IOSCO, they allow you to do that. We use them for portfolio construction without actually adding additional value. So ESG ratings are not the same thing as financial ratings because ESG represents our values. They have different methodologies in terms of sort of developing those ratings, and they're used for different purposes. So, and actually some firms are getting alpha out of that differentiation. And so I don't know that we need better disclosure. And obviously there's a lot of, ESMA and others are looking at forcing, imposing regulation on them. I'm a supporter of that. But I don't think that we should be asking in these early days we shouldn't be expecting them to converge. But I will actually turn that over to Andrea, who is actually the expert on this.
I think Lucy's desperate to say something, and then I'll chip in. Thank you, Ellery. Sorry to take over the narrating, but I think Lucy's trying to speak in here. And I can go after Lucy.
Yeah, thank you. I'm not desperate, but thanks for giving me a word. Yeah, I think we forget a lot about politics behind finance. That's not everything it's about pricing. Unfortunately, that would be quite easy. I think we forgot too easily that the energy transition is not meeting everyone's interest, and that some companies are gonna lose and are gonna fight against the energy transition. And I think today the leak that have been released by Euractiv regarding the taxonomy being under pressure by the gas industry in order to integrate the gas into the taxonomy using fake arguments regarding the grid stability, which has nothing to do with the green taxonomy. It's a good example of how the energy transition is just a simple process of deciding based on science what is green, what is not green, and then to monitor change. A second example that I think we could use is that sometimes the financing signal doesn't make everything to drive finance out of underperforming sectors. And I think coal is the best example we could use in this regard. Financial institutions can definitely benefit from a coal exit. In December, a report has been published by Société Générale about how European insurer and reinsurer are performing when regarding how, depending on how they have adopted a coal exit policy. And we can see that insurers such as AXA, Munich Re, Swiss Re, etc. are overperforming compared to their peers, and there is a clear correlation according to the analysts from Société Générale about with the fact that they have adopted strong exit policy from the coal sector. But unfortunately, we can see that a lot of financial institutions that don't like this information and they're aware of that coal is raising a lot of financial risk in the long term, but it's also underperforming right now. Financial institutions that have strong expertise internally, and we can listen from Ellery from Citi, but the bank is still financing is an industry which is not profitable. Citi has provided 33 billion of financing to the coal industry since COP21, and as one of the weakest coal policy worldwide currently, still financing some of the worst companies developing new coal projects. So clearly it's not always about numbers, and maybe we should not bet everything on a carbon price or this type of things, because yes, it seems like I'm quite young in the climate space, but I have been hearing for a couple of years, we are getting there, yes, we are not there yet, but it's changing. But unfortunately, we need to keep in mind that we have only 9 years left to change radically the way we produce and consume energy. And maybe instead of betting on how we will integrate financial risk into the way financial investors and banks and insurers are making decisions, maybe we should take a more clever precautionary approach, because what is killing us, we know it, and we can take the decision on a daily basis to stop supporting the development of sectors that we know we need to phase out very quickly in order to remain below 1.5.
Okay, do you want me to respond now, or?
Andrea, go ahead. I do have to clarify the coal policy because I do think that is actually old information from the fossil fuel report, because we have updated it and we have one of the most robust coal policies in the world right now.
And I thought I might just add into that. So I agree with you. We need to probably work with a little greater, well, with a lot greater sense of urgency. But I think what we're here to talk about today is what are the practical steps that are being taken in order to get us there. I agree with Ellery. Sustainability ratings and performance evaluations are completely different from credit ratings because of the dual materiality and the multi-stakeholder performance evaluation that you're doing. And I think there is going to be a need to make that a mandatory input for considering performance. And so the signatories to the PRI, because again, another concentration point, are looking closely at that stuff. And as soon as we do have disclosure, we can start to do better evaluation. And it isn't just for asset managers. So the central banks are starting to stress test banks' portfolios in the same way that they did during the financial crisis to make sure that they're adequately capitalized and they're taking into consideration the cost of the business they're doing. And one of the things that we do at Moody's is we provide the inputs and the models to do this stress testing, and we are preparing to incorporate physical and transition risk considerations into that, so that the central banks, I think led by the Bank of England in June of this year, can start to evaluate what the impact is, okay, on the bank's portfolios, and then start to set criteria for stress testing thresholds, which start to influence the behavior and the capital allocation of those institutions. So I think when I look back at it, like when I step back, they're going for the points of concentration, right? And I don't think it's realistic to say, we're just going to exclude brown industries and we're going to strand all those assets. I think it's really important to get the information into the hands of people who have influence so that they can engage and do stewardship in order to accelerate and commit with these companies to their transition. Okay, so if we just start excluding companies and financing them, they will find people to finance them. It just won't be through the public institutions, it'll be through private capital, and that's not going to solve the problem. There's one last point I wanted to make specifically because of this audience. We talked about the fact that young people are engaging on this topic and it matters to them, and they exhibit the consumer behaviors that are going to make this permanent. The other thing young people need to realize they need to do really, really fast is they need to engage politically, because the older populations, who I think struggle not uniformly, and I know this is a gross generalization, but they are the people who are voting for the policymakers, okay? And they're often voting for their pensions, and they're not thinking about what's going to happen 50 years down the road, because frankly, they're probably not going to be here. So there's a big responsibility, I think, on the youth of today, and it may be premature and it may be unfair because in our generation, you didn't have to be that engaged that early, although I was. But you do need to engage, and you need to think deeply about the policy platforms that the different parties are running on, so that you put these issues front and center in the policy platforms of the parties that are running.
Thank you all. I'm sorry, but we are running out of time, and this subject is captivating, but we'll have to move on to the next topic. There is this consensus regarding the momentum, the need for harmonization, but in data disclosure and regulation. And more fundamentally, can we imagine this new purpose for finance on a longer term perspective? So, and what would be the key driver to converge towards a new model? These are the questions we'd like to address in this last part. And I'd like to hear all the panelists to speak out on this fundamental question. Maybe Lucy, you can start.
Sorry, I didn't hear the question.
The question was about the move to the potential shift to a model not only based on profit maximization, but how to go towards this new model.
So maybe to stick to my favorite topic, Cole. So there is quite encouraging trend, even if it's far too slow. So for a long time, we have seen financial institutions excluding companies from because of their activity in the coal sector only based on their relative exposure to the coal sector. So for example, Barclays has been excluding and is excluding companies that generate more than 50% of their revenues or power generation from coal. And obviously that's about managing the financial risk related to the coal industry for their own and the impact it could have on their own performance. I mean, what is not good with this approach is that you will find below the 50% threshold a lot of companies that are among the biggest coal producers or among the biggest coal power producers, or you will even find companies that are developing new coal assets. So assets that are completely inconsistent with the 1.5 budget. And actually, you will find below 50% threshold companies that are developing more than 320 gigawatts of new coal power capacities. So that's the coal fleet of Russia, Poland, Germany, and India taken together. So that's the kind of companies that Barclays can still finance because of its policy, which is only about excluding companies that represent a financial risk for them. And you have plenty of financial institutions with that kind of policy when they do have exclusion criteria at the company's level, which is not the case of everyone. But the good news is that this is changing. In 2017, AXA actually acknowledged the fact that it's not only about managing the financial risk on its portfolio, but it's also about managing its investment impact on the climate. So not having a responsive approach to climate change, but more proactive approach to climate change. Instead of making sure we are not impacted, let's make sure that climate change is not happening. So we will stop financing and investing, then insuring companies that are developing new coal assets. We will also stop supporting companies that are among the biggest coal producers, regardless how risky they are currently for my portfolio. And AXA started doing it in 2017, and then most of the French financial institutions right now are getting there. And we can see that it's growing beyond France with UniCredit in Italy, but also the Canadian bank Desjardins. And we can also see some movements in the UK right now on this regard. So that's very exciting, positive news. Another one is everything that is happening in to make the financial products more dynamic. Again, as I said at the beginning, it's not only about making sure that you don't finance fossil fuels and only finance green, because obviously there is not enough green, and it's about transition. It's about pushing a company which is active in fossil fuels to decarbonize its portfolio. So we need more dynamic products. And up to now, we have been very critical about the green bond markets, because the green bonds are only about like the use of proceeds, and you can have a company on a Monday that issue green bonds, and from a Tuesday to a Sunday is developing new fossil fuel assets. That's what we will call greenwashing. And then you have the new kind of bonds that are being in development, and like transition bond and sustainability linked bonds. And we can see some, and which are more about like looking at the nature and quality of the issuer. Is the issuer changing and has pledges to adopt carbon reduction targets? So great news is that you will see that even at the green bonds, some change, that some financial institutions are going beyond the idea of only looking at the use of proceeds. For example, in December, you have Moody that had stated that he was divesting from a green bond by the Indian bank SDI, because the bank was actually going to finance a coal mine in Australia, which wasn't connected to the green bond, but it was just like, I don't want to be connected through green bonds to bank, which is actually bankrolling one of the massive coal mine, completely inconsistent with the 1.5 target. So that's a great news. And unfortunately, because always unfortunately, it's not a linear trend. And we can see that the new financial products can still be used for greenwashing. Very recently, like a few days ago, you had a midstream company named Enbridge, which had issued a sustainability-linked bond of 1 billion, and this bond is linked to the climate measures and pledges of the company Enbridge, which is actually very well known in worldwide for pursuing the development of a new tar sands project. So that's something that definitely it's also very concerning, because here we don't have a company in front of us which is truly decarbonizing its portfolio while it's still developing new fossil fuel assets. So we believe the transition won't be linear. Of course, it will always be like a step forward, and a step backward, but the idea will be to accelerate it. And the change in coal right now is maybe like the most exciting news that we can think about today.
Thank you, Lucy. Bertrand? We can't hear you. You're on mute.
Ah, okay. No, I will try to repeat and not to repeat what I've said. I think this conference is energizing. I mean, we all agree that there is something happening, and this is positive. And I really don't want to spoil the party, and I really want to join the party and say let's move forward. Let's build on that momentum. But at the same time, as I've said, we should not fool ourselves. It's just, I don't know whether Churchill said it's not the beginning of the end, it might be the end of the beginning. So this is really where we are today. We have a number of pieces on the table. It's been described by all the participants today, but complacency should not be the name of the game today. It's still extremely fragile. As I said, the system today is accommodating what we are doing, but the system itself has not changed. And the system itself is still driven very much by what Milton Friedman said 50 years ago, exactly in September 1970. The purpose of business is to increase its profits. It's not said that the purpose of business is to take care of the planet. The purpose of business is to take care of the people. It's to increase its profits. So as long as we don't change the operating system, we are at risk. And I will repeat this again and again. I think the second point, finance is critical. I wrote a book after the various discussion of 2015 called Can Finance Save the World? I've met a number of people, and I would say 99% of the people on the planet would say no, there is no way finance can save the world. There is a very bad image of finance wherever you go, so we should not forget that. We come from far, and we have to regain respect and trust. It's not because the COVID crisis was not a financial crisis that it's done. We have a lot to do. And my last point, two last points, sorry, last point is we should not focus. I mean, it's important we focus on advanced economy. My job is to invest in emerging and developing economies. Sustainable development and climate and etc. is very critical in emerging and developing economies. And this is a parent pauvre. I mean, this is the thing that we ignore. We are focused on the great ESG performance of the Fortune 500. It's great. It's going in that direction. It will move. we have now to work a lot hand in hand with emerging and developing economies. And we are not the bobos in paradise telling them this is the way you should do. We have to partner with these people. We have to listen. And it's very important. That's very important. And I think it's critical. And my last point, very last point, is again, and I've used this quote quite often these past few days, a quote from Tolstoy in War and Peace. He said, everybody wants to change the world, nobody wants to change himself. And the change will not come from the outside. And we are all schizophrenic. As investors, as consumers, we know the dilemma we are facing every day. So if we don't do the right choice ourselves, we will take collectively the wrong direction at the crossroads we are facing today. Thank you very much.
Thank you, Bertrand. Maybe we could hear George.
Yeah, a few general reflections to add on what has been said. Finance is part of society. It's an integral part. So it always will move together with and depending on, sometimes a bit faster, sometimes lagging behind. I think finance is now catching up really with the cutting edge trends on the climate issue, being more aware of the risks, being more ready to change. And it's happening in many important ways. But in itself, I would fully agree with Bertrand, unless we change the operating systems. And for me, it's primarily a price signal issue. Until that is solved, the big scale impact will not happen. But we are getting there. I do believe we will get there. I also like to remind, like Bertrand says, that 30% of greenhouse gas emissions come from China alone. If China makes it, then the rest of the world has a chance to make it. If China doesn't make it, then whatever we do in Europe or the US, it doesn't really make that much of a difference. So we have to think of the globe as a whole, not just of our own experiences. And the last point I want to make is systems change is not an easy thing. We have been used to the industrial era mindsets for 200 years. We were educated in it. We all think in terms of processes, of linear changes. We are in an age of accelerating change with technology, and I like to claim externalities increasingly forcing our hand. So we need agility, we need more readiness to experiment, and we need also more preparedness to move ahead. And that's why I believe a good way of approaching these issues is to recognize the big trends where we are moving. And I don't want to repeat myself, but it's very clear where we are moving. And the more and the faster we can move, the more likely we're on the winning side and not on the losing side. And that's why I believe finance has a fundamental role now. And I'm personally totally delighted that finance is waking up. I'm an engineer by training. I was always distrustful of finance. I used to kick them out of my office at the United Nations because I thought, wow, another one who wants to sell you something. But I realize now finance has the power to not only be part of the solution, but it actually can accelerate a number of trends that happen there.
Thank you, George. Andrea, what is your point of view?
Thanks. I completely agree with what people are being said, but I don't know that it's practical at the stage we're at now to expect a wholesale change in the system. So I would agree with Georg that finance is a aggregating, concentrating location where regulators and standard bodies can channel their objectives so that it gets transmitted a lot faster than it might otherwise happen. I also think that some of what we need to do is encourage companies, financial institutions, governments to change the narrative. And I agree with you. The industrial era has meant that profit and industrialization was what meant success for us. And what we need to do is we need to rethink how we define success up front. a lot of what we've spoken about today is how can you manage and how can you measure outcomes at the back end? And really, this is about how do you set guiding principles up front that define different measures for success and then communicate that success equivalent to the financial and the profit success. And that I don't think requires a wholesale change of the system. Right. I think that requires changing expectations on the part of finance to say, I want to see your guiding principles up front, and then I'm going to measure your impact. So we can bring together outside in and inside out evaluation, and we can start to say, here's what you said you were going to do, and here's what's happened, and here's where you can do better. And we can't always say everyone's horrible. We have to say you're embarking upon a journey and we're going to get there together and hold each other accountable for approaching it in a very sound way that serves the objective of multi-stakeholder benefits.
Thank you. Thank you, Andrea. We'd like to hear Ellery.
So I know that we've nearly run out of time. And first, I want to thank you, Juliet, for hosting and the conference team for organizing this. I think this has been one of the most enjoyable panels I've been part of in a long time. So thank you very much also to the other panel members. I have to say, I'm going to say that I'm really hopeful. ESG and climate risk integration is accelerating really quickly. I do think that we're beyond the tipping point. I mean, every day we have countries and banks and asset managers and corporations and others committing to net zero. It's imperfect, it's a challenge, but we are now have a level of engagement that over the course of my time that I haven't seen before. I agree with Bertrand that we need to have a new economic model though. I'm a financial professional now, but I've spent half of my life as an activist and the other half as an academic, well, as an activist and an academic. And quite frankly, we failed the environment. The reality is the finance and economic model that we have built this economy on has been destructive. And we blame the financial system, but realistically, we are the financial system. What we buy, how we invest, as Andrea said, who we vote for. I mean, we are the system. We have to change the system. I'm hopeful. I'm going to go back to Juliet's opening stat of 45 trillion of AUM is aligned with ESG. They expect by 2025, a third of AUM will be ESG aligned. That's really powerful in terms of those tipping points that I mentioned. It's about the tipping point, about the way that risk and return is being evaluated and the lens through which we evaluate how we deploy capital. So I'm going to end the night being hopeful, particularly because all of you, 950 people, dial in to say, how can we change the economic model to address climate change and biodiversity loss? So it's up to all of us, but I think we're going to lean pretty heavily on this next generation.
Thank you. Thank you all for great insights. We are running out of time, but just as a conclusion, if we consider that transforming the model is possible and that finance could become a means to fuel profitable solutions for the planet, in your opinion, just in a word, what is the main driver to achieve this transformation? Just as a conclusion, very quickly. Lucy, maybe first. Did you hear me? George, maybe?
Yes, I think the key is two things. It's valuation and valuation. How we perceive the future and how we are capable of managing different timescales in an integrated way. We have to adjust our minds to a rapidly changing world, and we have to become much better in anticipating what we don't know yet. But we know certain things will happen, but we are not yet prepared to integrate it into our valuation day-to-day behavioral system. And I think we all are challenged there to make that bridge happen. In my view, it's all about valuation and perception.
Thank you. Bertrand? We can't hear you. You're on mute.
Oh my God. I will echo what Georg just said. I think for me, all these things might work if we connect valuation and values. I don't think there will be real valuations which is not based on real values, which is the point I think that Andrea has made very clear. It's integrity. You cannot say something and do something else, etc. It will be more and more painful and more costly. And I think this is the way to move forward, when people walk the talk and not just talk the talk, as is too often the case. So I think this is what is very energizing in that conversation. I think there is a way forward.
Thank you. Andrea, what would be the main idea for you?
Yeah, I mean, in addition to what others have said, and I'm very hopeful as well, I think it's about standards, and I think it's about harmonization and agreement on what constitutes value, and what our values are can be individual. And as long as everybody knows what it is, so that there's clear labeling on the package, I think we're gonna get there. And I think regulators have a role to play. I'm not convinced that the industry, from a ESG and sustainability perspective, is ready yet, because you would be regulating things that are still in formulation, and you may kill innovation. But I do think that there is opportunity here, as long as we standardize, measure, and then manage what we measure.
Thank you. Before moving to the other speaker, just a last question from Geoffroy Bazin, Chamber of Commerce in Luxembourg. As we have seen almost the entire world to set a global coalition to fight against COVID-19 in an emergency mode, with the vaccine rapidly delivered in particular, why this emergency mode is not adopted or does not work for climate change, despite the Paris Agreement and the consequences that could be much worse than the current outbreak? What is missing, and what solution would you propose? Do you think profit is intrinsically opposed to climate responsibility?
Can I give it a shot quickly? Or
very quick.
Yeah, I think we human beings, we are just imperfect. We are lazy, phlegmatic. We don't like to change. We don't like to risk something we are not certain about. We have a herd behavior. We are tied up in the same mindsets we have been educated in. The climate change is unfolding. We are in a climate crisis already, but it's localized. So we like to believe that it hits others, not me. We will react, however, and I'm confident we have a great capacity to adopt and to react. So we have to create a sense of urgency, but we can't overdo it either. Otherwise, we are being accused of being wild doomsdayers. The new narrative has still to be developed, I believe. We are all still tied up in the myths of the past, and our minds for the future are not bright enough. It's our human limitations, I would argue.
Lucy, would you'd like to add something?
Yeah, maybe I will just add that it's completely, I mean, a fair question, and it's sad, but unfortunately, the COVID, we have been hearing about a lot of conditionality that the public side should put into its support to companies, and unfortunately, we will release financial data in 2 weeks' time from now that will show that some banks, not all banks, but some banks, and mostly French banks, have supported massively the fossil fuel industry without putting any condition to the support. So COVID hasn't been a wake-up call to the finance system. And to conclude, I will say that as finance can definitely help in driving the energy transition, but it will require accountability and integrity. And I think it's going to be very important, because we can often hear a lot about ESG without putting no meaning behind it. We will find exactly the same companies in ESG funds that we will find in other products. And I think in order to hold the financial institutions accountable for the impact in driving climate change, the regulator will have to step in order to increase transparency and the integrity of the financial products that are marketed.
Thank you. Maybe a few words from Hilary, very quickly.
So on COVID and why it hasn't been adopted, why we aren't seeing the same level of adoption. First, I don't think that we focused on the science the same way with climate, that's the same way that we have with COVID. But I think more fundamentally, as the others have said, the reality is we think that climate change happens to someone else, and it happens over a long period of time, and we don't associate weather or other events as climate change. And I'm going to be really tactical about the two things that I would really like to see in the market, and I completely agree with values and so on, but the reality is I want to see a carbon price. That is like one of the most important things to be able to facilitate risk return analysis and carbon transition. And the other thing that I want to see is disclosure, and that harmonized disclosure that Andrea has spoken about. We need to be able to see information. Financial markets are clever. They will make financial decisions. We see that these are risks now, increasingly so, but we need the information to be able to make these decisions in a proactive, constructive, timely manner.
Encore une question. Je l'ai pas reçu. We have to end very shortly, but just the last question from Redouane Zad for Bertrand. Do you think that the new regulation which will enter into application this month, Sustainable Finance Disclosure Regulation, we came into force yesterday, will win the game against greenwashing?
Well, yes, I'm not on mute for once. So no, first of all, it will enter into application because I mean it's in application, and as a fund manager, I had to comply at the last minute to make sure that I was okay with all the papers and all the requirements. So I think it's a real one, and it's a very important step. Will it be enough? Probably not. I come back to what I said. There is a geopolitical element into that. Are we able to agree, in particular with the US, on a set of norms that will really change things? Or is it going to be a competition between Europe and the US on who is going to say what is good and what is bad? So again, it's starting. It's not done yet, and it will require the vigilance of everybody, including people in this room today, to make sure that we do not fool ourselves.
Thank you, Bertrand. Unfortunately, we will have to end this very captivating conversation. Thanks to all the speakers for their insights, and thanks for the audience for joining us tonight. And have a nice evening. Thank you.
Afternoon in the US. Thank you.
Yeah. Bye.
Bye bye.
Thank you, everyone.
Thanks to all.